The phenomena of declining birth rates, aging populations, and even population decrease have become issues that countries can't ignore over the past few decades. These trends could lead to a labor shortage, welfare system collapse, and soaring government debt, among other economic challenges. But declining birth rates aren't all bad news. For instance, with fewer people, there might be more resources to go around, especially those limited by nature, like land and real estate. Some folks believe that the population decrease following declining birth rates could be the cure for high housing prices. But is that really the case? Japan ranks second in the world for its aging population. Yet, a recent report in the Nikkei Asian Review mentioned that the average price of new apartments in Tokyo has surpassed 100 million yen, continuing to set record highs. So why, in a country where the total population has been decreasing for years, are housing prices still soaring? In today's video, we'll delve into the changes in Japan's housing market over the past few decades. How has Japan, with the most severe aging population globally, managed to see record-high housing prices, and for foreigners, could this be a great investment opportunity? So, let's get started with today's video. The 1970s to the 1990s were the golden era of Japan's economy, especially in the automotive, industrial, and semiconductor sectors. At one point, Japan held over 50% of the global market share in random access memory. This dominance led to significant losses for American semiconductor companies, including AMD, National Semiconductor, and Intel. Eventually, Intel even withdrew from the RAM market, while Japan's Fujitsu nearly acquired Fairchild Semiconductor. With Japan's rapid growth, the late Harvard professor Ezra F. Vogel published Japan as Number 1 Lessons for America in 1979. This book highlighted lessons the West could learn from Japan, whose GDP per capita surpassed the United States by 1987. Amidst this rapid growth and influx of capital, Japan also faced an unprecedented asset bubble. The Japanese stock market peaked in December 1989, with price-to-earnings ratios around 60 times, far exceeding those of other countries during the same period. That year, 14 of the world's top 20 companies by market value were Japanese. A similar bubble was seen in real estate. At the height of Japan's property bubble, the Imperial Palace in Tokyo was worth more than the entire state of California. But the good times didn't last. The stock market bubble burst in 1990, and real estate prices started to plummet the same year. According to Japan's MLIT, Tokyo's real estate market entered a prolonged bear market, with prices falling by as much as 61% until showing signs of recovery around 2005. This period became known as Japan's lost decade. The Japanese economy's long-term stagnation has several causes, and one major factor is the aging population issue. Japan's working-age population peaked in 1995, just a few years after the real estate bubble burst. The total population reached its zenith in 2009 and then started to decline. By 2020, the median age in Japan was 48.6 years, the second oldest population globally, right after Monaco. While many European countries face similar aging issues like Germany, Italy, Greece, etc., Europe generally has a more open approach to immigration. This helps maintain a certain population level, unlike Japan, which has stricter immigration policies. As a result, Japan has been among the world leaders in population decline over recent years. The economic downturn combined with a decreasing population has significantly impacted Japan's domestic market. Japanese real estate prices continued to fall for over a decade following the bubble's burst. This trend is understandable. With a shrinking population, the demand for housing decreases. Plus, the real estate bubble during its peak had inflated prices excessively, leading to the prolonged slump in property values. For those interested in this topic, check out Matsui's channel. He has visited many areas in Japan, including what I'd call a ruin series. I believe these once thriving areas, now in decline, are the most tangible record of Japan's burst economic bubble and aging population. But if that's the case, why do new apartment prices in Tokyo keep setting record highs, surpassing even the bubble period of the 1990s? One reason for the continued rise in Tokyo's property prices is Japan's easy monetary policy. After the bubble burst, Japan implemented various policies to stimulate the economy. For instance, they introduced a zero interest rate policy in 1999. When that didn't have the desired impact, they moved to quantitative easing in 2001. These monetary experiments tightened in 2006 due to global inflation, but then ran into the U.S. subprime mortgage crisis and the European debt crisis, so their impact on Japan's economy was limited. In response to similar aggressive monetary policies in the U.S. and Europe, the late Prime Minister Shinzo Abe introduced Abenomics in 2012. This included unlimited quantitative easing, a weaker yen, and a 2% inflation target. The Bank of Japan's balance sheet ballooned from 139 trillion yen in 2011 to 756 trillion yen by 2023, a four-fold increase in just about a decade. This had a significant effect. Tokyo's apartment price index began to rise from the bottom in 2012, from around 100 to 194 in 2023, almost doubling and surpassing the bubble-era peak. Another reason for the price hike is the strong demand for real estate in Tokyo. Although Japan's overall population started decreasing from 2009, Tokyo's population, or the larger Greater Tokyo area, kept growing. This area, occupying just 3% of Japan's land, is home to about 37 million people, roughly one-third of Japan's total population. Japan refers to this as Doshinkaiki, means the U-turn migration, where people move from suburbs or smaller cities back to major metropolitan areas. Why? Well, during the asset bubble, Tokyo experienced net population outflow, mainly due to sky-high property prices. But as the bubble effects faded, Tokyo's real estate became more affordable. The big city offers better job opportunities, higher education, and medical facilities, making life more convenient. So, people gradually started moving back to places like Tokyo. But this influx made Tokyo even more crowded, driving real estate prices higher. The average price for a new apartment in Tokyo is now about 100 million yen. We found some new apartments in the Tokyo Bay area and Meguro district on the Japanese real estate website at home. These are new and traditional residential areas in Tokyo, with prices for properties around 58 to 74 square meters, which is about 624 to 796 square feet, costing around 67,000 USD. What do you think? Is that an attractive price? With the ongoing population influx, Tokyo is getting more crowded. In recent years, the Tokyo government has offered incentives for families to move out of the city. For example, they recently proposed a 1 million yen subsidy per child for families moving out of Tokyo. But the effectiveness of this policy is debatable, as not many families have actually moved out. So, does a declining birth rate necessarily lead to a real estate crash? Well, Tokyo's experience suggests otherwise. Japan, with the fastest aging population globally, provides a valuable reference for other countries. Many Asian countries like Taiwan's Taipei, South Korea's Seoul, and China's Beijing, Shanghai, and Guangzhou are experiencing similar trends of urban population decline and suburban migration, a situation Japan faced over a decade ago. But over time, these cities could see a resurgence in population due to urban migration and monetary stimulus. However, it's important to note that not all of Japan is seeing a real estate boom like Tokyo, which even reclaimed its bubble-era peak prices. The flip side of urban migration is the outflow from smaller cities and rural areas, reducing the demand for real estate there. Aside from the declining business districts that Matsui's channel covers, we often see in Japanese anime the scenario of the protagonist moving into an empty house in the countryside. In Japan, many websites list these vacant properties, some going for as low as 100 yen. The MLIT has even authorized private websites to list public properties for sale, including abandoned schools, old government dormitories, and public lands. Real estate prices in Japan's non-metropolitan areas are actually not that high. For instance, in the areas around Kyoto, about a 90-minute drive from the city, you can find properties priced between 1 to 3 million yen, with sizes ranging from 100 to 400 square meters, including farmland, forests, and warehouses. This phenomenon isn't unique to Japan. Italy, facing similar issues of aging and population decline, has seen a significant rise in property prices in metropolitan areas like Milan. Meanwhile, some Italian towns are offering houses for as little as €1. But these cheap properties often come with hefty renovation and maintenance costs, so foreign investors should be wary of such deals. Another thing to consider is the change in the real value of assets. What the Japanese government did was to boost asset prices by printing a lot of money, effectively devaluing the yen, which was exactly what Abenomics aimed to achieve. For foreign investors eyeing the surging real estate prices in Japan and thinking about jumping in, there's the issue of the yen's depreciation to consider. Take Tokyo apartments, for example. They've increased by 87% since 2012. However, during the same period, the yen has devalued about 80% against the dollar. This means there's not much profit margin for foreigners, unless you live in Japan or have a significant need for yen. Like the time Taiwanese YouTuber Joman did an unboxing of famous Taiwanese author Wu Danru's Tokyo property. It's a beautiful house and its price has increased. But when converted at the current exchange rate, the profit isn't that high. However, since it's for her own use, it's not a big issue. But it's something to be aware of for investment purposes. Also, don't rush to buy just because the exchange rate seems low. It is important to consider like taxes and maintenance costs. And remember, everything we've discussed today is not investment advice. Please do your own research before taking any action. So overall, a declining birth rate or decreasing population doesn't necessarily have a negative impact on property prices, especially in major metropolitan areas. But it's not some special magic or a sign of overall economic improvement. The main reasons are the urban migration following population aging and the effect of massive money printing and loose monetary policy. With major central banks around the world struggling to move away from stimulative monetary policies, real estate prices in global urban areas are likely to keep rising and getting more crowded. So after watching today's video, what other factors do you think can affect real estate prices? If you had 100 million yen, would you choose a luxurious apartment in an upscale metropolitan area or a large, affordable house in the suburbs? And would anyone be tempted to try the 100 yen houses in Japan or the €1 properties in Italy? Feel free to comment below and join the discussion. See you in the next video. Bye.